Hello, everybody, and welcome back to the M3 Market Update. My name is Melody Wright, and I do this show to give you context for what's happening out there in the housing market. And it is going to be a very, very interesting year. In that vein, today I'm doing something a little differently than I usually do with the M3 Market Update. And I've got a special guest today, Mark McDonough, who's joined me, who has been in mortgage for over 30 years. And he has some updates on what's going on with FHA that he wants to share with us today. And as you guys know, I often focus on FHA because how I've called it, and so have others. I'm not sure who was first to say this, but essentially, this is government-sponsored subprime that has been originated, and it has doubled in origination since the GFC. And in many ways, there's a chart that I'll try to link below in the show notes. You can look and see where the private line back during the GFC, kind of the amount of origination they were doing, and the FHA lines, they just kind of switched places. And so FHA kind of really took the share that the private market had previously. And why is that important? Theoretically, people say that the subprime market is what took down the housing market. We know that's not exactly true. There are a whole bunch of different factors, and ultimately, your prime borrowers are the ones after those job losses that really made delinquency spike materially. But yes, did it start with the non-traditional products and the subprime? 100%. So today, without further ado, Mark, thank you so much for joining me today. I just want to kind of turn it over to you and just give us a little introduction and take as long as you want to tell us a little bit about how you got started in mortgage and just kind of your journey. And I'll stop you with questions along the way.
Thank you, Melody. Thank you for the opportunity. I've been in credit and lending since Jimmy Carter was president, to put it in perspective. I, like everyone else, accidentally got into it. I did nothing but collection work for a consumer finance company, worked my way through managing those consumer finance companies, making small loans, making second mortgage loans, graduating to the mortgage industry, going through the 70s, the 80s, the 90s, working for major lenders, doing origination, eventually managing large branches, doing origination, processing, underwriting, everything. So I have done pretty much everything mortgage, from knocking on the door, collecting the payments, to typing the mortgage, to anything mortgage related. I've been in the industry a long time. Now, in the last, well, this is the first year I'm technically not a mortgage lender, as last year my old boss, Jerry Devlin, and I opened up a company called Assume Loans. And it was more of a lock than a real venture. And it was because we were both financing fossils, and we were around the last time assumptions were popular. And we were of the opinion that given the market, the assumability of FHA and VA loans, there would be a real avenue to maintain some level of affordability in the housing market by those loans being transferred with property. And it would be something that would be beneficial for everybody involved. We naively thought the loan services would be enthusiastic about perpetuating the loans, and the regulators would be on our side, and it would be just hunky-dory. And we've been very successful getting things done, but after what we've been finding out about what's going on with FHA and things, it's been kind of a little different.
Yeah. So why don't we take, and this is kind of a off the cuff question, but, thinking about the different cycles that you've been through, maybe take us through each one and just tell something you remember, like about the 80s cycle, for instance. Did you do seller financing back then? Or saw that happening?
Yes. Well,
Okay.
back in the 80s, I mean, it was vastly different. I
Can you
remember
describe it? Yeah, go ahead.
waiting for credit reports to come in the mail. Obviously before email, before any type of technology, keeping 3 copies of mortgage files when they were closed, so you had to have enormous amounts of space. 2 face-to-face meetings with borrowers with FHA, not having a loan possibly approved with over a 41% debt ratio. I mean, it was rigid and specific, and the transactions were, I'd say, more important to everybody involved, certainly much smaller. I remember FHA's maximum loan amount at $88,000.
Wow.
And it seems like the cycles I can remember where there's been significant changes, there'd always been some type of regulatory adjustment that allowed for an exploitation of the market, and I think we're in one now. This reminds me very much of 2004 and 5 when I was managing a very large branch for a major national lender. And I think I mentioned my partner in the assumed loans, Jerry Devlin, was my boss, and our offices would be beside each other, and we'd be talking about, this can't be real. This can't continue. And we were more looking at the option arms than the subprime. We knew subprime was going to blow up. That was a given.
Right.
But the option arms also had a 125% negative AM explosion, and nobody was paying attention. But it was obvious to those of us in the industry with just the right amount of knowledge.
Right.
If you were a street person, you may not have the backroom knowledge. If you were backroom, you wouldn't have the street knowledge. I guess fortunately or unfortunately, I was involved in both, and I could see it.
Yeah, what I find interesting about that time, and then I want to go back to something you said, but I got started in October 2006, and it was so interesting to me how little my executives understood about what was actually happening. And and we had like a couple of people in risk, and I was born a skeptic, and so I'm always kind of looking, stepping back and kind of looking at everything, and the excitement I saw was just a big, red flag for me, when I saw everybody partying like, oh my gosh, and they didn't think it was ever going to stop, and the balloons were falling from the sky, and I could look around and see that didn't make a lot of sense, but we'd have the one guy in risk, but the executives would just shut him down, and so it's
Yeah.
funny to me that you say in 2004, 2005. You could see the writing on the wall, but so many people at the top had no idea.
I remember being at a managers meeting with the CEO of the mortgage group for the company, and it was a top 10 lender, and discussing with him saying my monthly P&L, this is before Dodd-Frank, obviously, and saying, how can I be getting credit for the servicing values on these loans that are projected to last 4 years when they're being refinanced in 3 months?
Right.
This doesn't make any sense.
Right.
None of this makes sense. And then the decreased level of risk when there were two waves of stated income or no income verification loans that went through for the convenience of the borrower. That was an exercise in idiocy. I mean,
Yeah.
I used to say we were part of a very big branch in a regional ops center. There should be no reason that we don't have people come in and sign the closing documents, because what we're doing, if you're allowing somebody not to verify their income and have a 500 FICO score and no discernible employment to get 100% financing, you shouldn't be surprised.
That's right. That's right. It's something you said about the previous cycle, because the 80s are very interesting to me, but you said, the transaction meant a lot more to everybody involved. Could you just spend a couple of minutes talking about that? Because I think
Yeah,
that's
I mean, that
important.
was prior to the information highway being what it is now. So the loan officer and the underwriter and the processor and the borrower were kind of intimately involved in a transaction that was not in a little black box, but it was there was a lot of respect given to everybody involved in it because of what they were doing. Now you go into an app and you put information in, and AI plays with it. You run it through an AUS system, and it gets ground out. Nobody's looking at the fact that there's a real person buying a real property with real money into it. You know, it's a more it, it was more significant then. That's just how I look at it when I look at it in retrospect.
I agree, and I think we've gotten away from, really understanding the mechanic of how credit really can how it works, how it
Yeah,
should be used. A great book I read, The Price of Time by Edward Chancellor. He goes back and he looks at interest rates from the beginning of time, or we were basically charging interest on loans before we could write. And then just talking about credit. And what I could see in my day is everybody was trying to Henry Ford the loan process, right?
yes,
They wanted to make it this assembly line. But when I worked in default, what I could tell you absolutely is that didn't work because you had 50 states with 50 set of laws. But by the way, within those states, you could have local ordinances, county, and the big servicers were trying to what you do as a servicer, you don't have attorneys on staff. You farm it out to these foreclosure or default attorney firms to handle these. And a lot of times, those default firms didn't even really know much about the state they were operating in.
yeah,
And that's something I found. But what I could tell when I took over default in 2012, after the robo signing crisis, and I was there to kind of get the department back on its feet, there was a group that did this process, a group that did that process, and no one understood the whole process. And so ultimately, you just had all of these huge delays and messes, and because you had hundreds of people all working on one loan without understanding what the other person was doing. I mean, it was a total disaster. And then when I kind of, I had been over corporate finance for origination and servicing, but I really didn't go into the origination side of things until the COVID boom, when I was kind of overseeing a loan processor group as a weird part of what I was doing at a fintech, because we also had business process outsourcing services. And, I could see that they were doing the same thing within origination and it was not making any sense. And then you also mentioned AUS, or the automated underwriting systems. This is something I don't think a lot of people understand. So do you want to just spend maybe a minute or so talking about what AUS is? Because I think a
sure.
lot of people don't even know what that term is.
Almost all loans are run through an AUS, an automated underwriting system. They're mostly Fannie Mae, which is DU, desktop underwriter, and Freddie Mac, which is loan prospector. And those are meant to, I think, those are meant to get rid of borrowers that are high risk, allow borrowers to be approved that are allegedly not, and allegedly is the operative term. And then it allows the lender to proceed with a transaction that the computer said okay to, that in my opinion may or may not make sense.
Well, what I found, and Mark, you tell me if this was your experience, I found that just like any video game, you can learn how to play it, you
Yeah,
know, and
yeah,
you know how to make a little adjustment over here and a little, because I actually was doing a lot of when I was in fintech and I was building software, I was doing a lot of interfaces with AUS, with Optimal Blue and things like that. And you start to realize, oh man, like this would be so easy to manipulate in terms of just knowing how it works. And you can make a little tweak here, can make a little tweak there. And I have now seen on this side of it. So I got out of any type. I really left mortgage 21, where I had my hands in anything on the process side. So that was 2021. But since I still have servicing clients, and I am looking at loans that blow my mind, Mark. Like we would have never approved those loans back during the GFC. And I'm just and I talk to my clients about this, and they're blown away. And we're like, how did this get approved? And so, even they don't really understand what happened. But you've got a whole bunch of and you also remember how crazy it was during the COVID boom. I mean, we didn't sleep, we didn't
right.
eat, we didn't I mean, it was absolute insanity. Like, we went to like I was on a project at PNC that where we were imaging refinance documents, and we went from some kind of volume of about 100,000 pages a day to 1,000,000 pages a day in almost overnight. I mean, it was absolutely. So what happens when you have, and by the way, they had to bring in a whole bunch of loan processors and underwriters who had no experience because to handle all that volume, or they outsource things. And so when you get into a situation like that, there's going to be all kinds of mistakes and errors. But I can tell you already, my clients and I are looking at this stuff and like, how was this approved?
Yeah.
You know?
Well, I mean, the old adage looking at FHA loans, and I previously worked for a lender in the 80s. I worked for Fleet Mortgage, and they were
Oh, I remember Flake.
99%
Yeah.
uh, FHA and VA loans. I managed the branch for them. So there was a time when well, actually going back even farther, you used to have to go, the ratios were 29-41 net income FHA, but that goes back to the 70s. And you didn't get an approval if it was a minor percentage point over. And everything, two different colored pens on the file would cause it, two face-to-face meetings with the borrower. That was egregious, but it did give some gravitas to the transaction,
Right.
as opposed to just running it through the mill. With FHA loans, up until certainly last year, you could get an approval in the AUS system with a 55.99 back ratio. Now,
Yeah.
it's hard to, and for anybody who's listening to this who's not in the industry, that's what percentage of your gross monthly income the lender would allow the mortgage payment and long-term debt to go to. Now, that doesn't take out the 28% you're paying in taxes, the 6% in Mass, 7.65 Social Security, 1.76 Medicare, all the other monies that are coming out. And I used to jokingly tell borrowers, if you do this at this numbers, this will automatically make you vegan because you can't afford meat. And don't rely on us as the lender to tell you what you can afford.
Right.
We'll
Right.
tell you what we will give you, but I've been in the industry a long time, and it does periodically jade toward larcenous intent and larcenous performance by large groups. If there's a way to exploit something, people find it, people figure it out.
Absolutely. And to you beautifully, because a lot of people don't understand front end DTI, back end DTI. So first I'll say DTI, debt to income.
I'm sorry.
So yeah. So Mark, why don't you explain the front end versus the back end? And
The
then we'll
front,
emphasize these points. Yeah, go ahead.
yeah, the front end of the transaction is anything pertaining to the obligation on the property, principal, interest, taxes, insurance, mortgage insurance, homeowners association fee, whatever it would take to support that property is the obligation that is the front ratio. Anything that is a long-term debt is in the back end, and that would be any revolving balances on credit cards, any mandatory student loan payments, any long-term installment debt that's over 10 months. So that's what the lender is, and every lender to some variation is looking at that, because it, I don't know if you want to get in, because after Dodd-Frank and the Consumer Protection Act, became an obligation for the lender to have the ATR rule for an ability to repay. We could no longer approve something just because we were making money from it. We had to show that the consumer could repay that debt. So that's the evolution of how the ratios became a little more rigid. But with the AUS systems and other methodology, I mean, we've gotten back to a point where I think we're making, there's a lot of loans out there that are not able to be paid back by the people that have them. I don't think that consumer knows this. I don't think that the people at the agencies, they all seem to be well-intentioned, but not informed of anything outside their compartmentalized function.
Right. Right. And it, and everybody can be well intentioned that's doing the work and have no idea what's actually happening,
Yes.
the larger. And I can tell you that. I know I was a useful idiot in the great financial crisis, so I know that for a fact. But this is so important because you go back to any literature. In fact, you can Google right now, what is the recommended debt to income and
Oh yeah.
to be able to afford a mortgage and not put yourself in distress. And it's you can go on to even like banking websites, the FDIC, when they're just telling you what is best practice, it's between 25 and 30%. They never go higher than that. And so for the FHA to allow for this high, and then let me tell you a quick story. One of the borrowers that I had to review for an early payment default, who by the way never made a payment. I'm doing a title report and I see that they're on a loan with somebody else. A whole other loan that never got even a whole nother mortgage that never got calculated at DTI. And so the due diligence just isn't the same that I
No.
have seen. And so I think it's even way worse than what we're seeing. And so one of my colleagues, Mr. Austin, and I are working on some Fannie Mae reporting around debt to income. And what we're seeing right now is you look, and we are with Fannie, and we're not talking about FHA. And so for the viewers, Fannie and Freddie are supposed to be much higher quality for the most part than what you see in these FHA, but we're at a 38% DTI, which we haven't been at those levels since guess when. And so it's just absolutely so what we're saying to you guys is that they're setting people up for failure, almost certain failure. And they think because there's two reasons, and Mark, you tell me if you agree. I think there's two reasons they think, and most of these guys honestly think they're doing a great service to people.
Oh yes.
They think that they're just trying to get them into a home. You can think about that in the Big Short when he's like, they just want a home. But what happens is you end up precluding them from actually owning a home in the future, often by destroying, their credit, their purchasing power. So, I just think it's they say that it's like, okay, well, home equity is rising. Have we heard that before? You and I certainly have heard that before. So they'll be able to refi, they'll be able to do something. And then of course, now you have these very aggressive loss mitigation programs where the partial claim program where you can correct me if I'm wrong, but you can basically put into a partial claim, and I'll explain what that is. It's very similar. It's like a silent second, except it's not exactly silent when because you record it. It's like a second lien. So let's say you have 12 months of payments that you haven't made. You can bundle all that up and put it into that non-interest bearing lien that sits kind of at behind the loan for to be paid off when you pay off the loan or you sell it. And so you are now looking at where I think the threshold or the limit is 30% of your unpaid principal balance. Is that correct, Mark?
Yes. HUD tried to sneak 40% through, but that's one of the circulars that are out for comment, and that didn't go through with the updated change.
That is, if you think about 30%, like think about how long it takes you to pay down the first 30% of your loan. Like,
Absolutely. And the numbers on those are in. I had pulled numbers from HUD's own website. As of the end of last year, there were 549,000 incentive claims paid, meaning those were, and the preponderance of those were partial claims
right.
where the borrower does not make the payment. They don't even have to have a conversation anymore.
I know.
The lender sends them the documentation to
Yes.
sign, makes the payment for them. I know we've traded some information on it, but I'm looking at properties that have annual partial claims. People that have bought, like when Jerry and I started our assumption that we were looking at it empirically, these people who bought in 19, 20, 21, they have very low interest rates. And if they bought with no money down, they've likely had income erosion from inflation.
Right.
And these people would likely be in a position where they could sell, market the assumability of the mortgage. And we had a methodology of figuring out exactly what it was worth. And they would walk away with more money. A buyer would get affordable financing. The servicer gets perpetuated servicing value. and affordability remains. That balloon got busted by the fact that many of these people simply aren't making payments.
Right.
I mean, and the numbers are staggering. Like when I look at, annual, and this is just a quote from, not from, I won't mention the prop, but they bought it for 730 and 920 of 21. They took out a $712,000 mortgage. 7 of 2022, less than a year later, a partial claim for 23,470. 8/15 of 2023, another partial claim for 57,711. And then the final partial claim was this year for 58,295. Now, if I put my collection hat on for a second, I'm looking at somebody that's over 100% levered. Probably the insurance doesn't cover that. How are they going to kick the insurance up? Who's going to make that happen?
Right.
And if a borrower allegedly qualified for a payment at that point in time, and then less than a year later didn't, there's a flaw in the system. There's a big flaw in the system.
Right.
And you're
Right.
absolutely right when you say that FHA is the new subprime.
Right.
Yeah. The thing that FHA does is, I mean, I firmly believe, and I think I've shared some conversations with people, that they believe they're doing the right thing.
Right.
A conversation I had with someone in a position of authority, well, we prevented 1.9 million foreclosures. No, what you've done is finance a housing bubble.
Yeah. Right.
And I even pulled, and we have these data sources because of the assumption business, but pulling properties that were sold this year. This one was sold last February of 2024 for 310 with a 303 mortgage amount. 7/17 of 24, they take a partial claim for 90,996. Now, I don't have firsthand knowledge of people colluding to do that.
Right.
But I also don't have firsthand knowledge of a lot of things I know to be true.
Right.
Right. And when I look at some of these, I look at, and I tend to be a data rat, as is probably already assumed. The HUD websites allow you to look at individual underwriters. And you can see individual underwriters that are and not one loan here or one loan there, that are underwriting hundreds of loans and have over 50% of those loans go to first payment default. That used to be
Big red flag.
Right,
absolutely. Absolutely.
But now it doesn't come back on the lender. It used to be loan officers would lose commission if that happened. I mean, everybody was upset about that.
Right.
Excuse me, since COVID, it doesn't seem to matter. I mean, they're sitting on a powder keg that has to explode, I think.
Oh, absolutely. And people can talk about, well, there's enough insurance in the fund and that, but sure, maybe, I'm actually working on an analysis of that. But we're talking about eroding purchasing power, right? And we're talking about people that won't be able to contribute to the economy because they have this mark on the, and they're going to have to sell, or they're going to have to lose the property. And I can tell you that in the client books I'm looking at, they can't sell. They're trying. They're not able to sell. And so I think this year we're going to see, I think last year everybody put a big pause on any decision, because of the election, because of the potential of rate cuts that really didn't happen or didn't turn out how they thought. But this year, you're going to, for what I'm already seeing, like, and it kind of happened overnight, is that, all those death, default, divorce, and the DOD, people have to get rid of these properties for some reason or another. And it's starting to shake loose at the margins. And this is something we've been waiting for But one of the reasons that it hasn't happened has been because of how aggressive these programs are. I mean, I've been talking about double digit FHA delinquency since basically June of 23.
Right.
In June of 24, we saw another cohort come over and a really big jump in 30-day delinquency. And I think this year, by June of 25, I believe more of Fannie and Freddie are going to join the party, but you're going to see a significant, even bigger, because what you're seeing on the back end right now, because I track servicer advances and things like that, is that you would see people get up to that 90-day delinquency and then 90 day they get swooped into a workout, swooped into a workout
Yeah.
because you're supposed to with FHA by 90 days you should be talking to them, you should be buying that loan out of the pool, having them on a trial modification. And so they were getting swooped up and so that later stage delinquency was not really going anywhere. Well, that has now changed and we are starting to see seasoning and late and rolling of later stage delinquency, which tells you that behind the dam the pressure is building up, and we are in early innings because that GFC style intervention with all of these workouts on the Fannie Freddie side, it was the payment deferrals. It has kicked the can, but we shouldn't really be seeing any delinquency right now at 4.1%
Exactly.
unemployment, but we are seeing massive. And if you take the privates and you add them, Mark, so Ginnie Mae, which is FHA, VA, they're 22% of the market right now, and together with VA and all of those are about 9% delinquent. Then you take the private market, which is about 3%, they're over 12% delinquent. And so together, you've got 25% of the market that is already suffering, like at a accelerated delinquency rate. And so believe me, this is the powder keg. This was in many ways you can look back and it was similar amounts of subprime
Yes.
that really started things in the wrong direction.
And in the 2000s, one of the things that sunk everything then were Washington Mutual and Countrywide were the
Right.
two major players for the option arms, and the option arms had the provision for negative amortization, and when that reached 125%, it went fully amortized. So you would have people go from a mortgage payment of 1166, which I remember used to be the amount for a $500,000 mortgage, to
Wow.
$4,000. And the caps weren't in place or anything like that. And it was all because the fuse was lit. If it had been allowed to continue, and you would have, the guy who cut the lawn buying his seventh investment property saying,
Right.
well, it doesn't matter because I can sell it for more money.
That's right.
That's
Right.
what has been happening here. Those partial claims have been alleviated by either foreclosure or sale,
Right.
but you cannot continue. I mean, this is some numbers from Neighborhood Watch, which I found astonishing. And this is quarter ending 12/31/2024, and this is origination entities and their delinquency first year and the top 100. Like this year, one company had 55.64% of its loans go delinquent in the
How
first
are
year.
they still originating? How are they still originating?
It's even worse because the underwriter is actually an owner of the company. You can look at the delinquency of the loans that have gone south. The interest rates on those loans were much higher, so what happens is more revenue. It just doesn't smell very well.
Mm-hmm.
And then if we go back exactly 3 years and pull that same report, the worst lender then had a first year delinquency rate of 12.47%.
Wow.
So it's
Wow.
not, I mean, it's impossible to not have somebody looking at this and say, what are we doing?
Right. Right.
And annualized partial claims. And in certain markets, we have access to more data. And I have seen FHA loans that I made in 2020, and the people get annualized partial claims. Now, whether or not, if they need it, we have a problem. if they're exploiting it, we have a problem. I don't know how it gets better.
Right. And this is something, so I shared on X Twitter. You can see, just like last time, it's the 2021 vintage that has the highest share of delinquency right now. And I mean it, and in 2022 and 2023 are quickly joining it. And that is always a very bad sign when you have that early stage delinquency.
Yeah.
And so it's fascinating to me that more people aren't talking about this. I mean, but of course, they're wanting, because what's funny is to actually look at FHA origination, Mark, at the beginning of the boom, and you could see it going down, right? Because Fannie and Freddie were going up, and
Yeah.
loan officers very well. They're going to go for the bigger balances, the easier loans, which are going to be those prime borrowers. But then as that started to peter down, you have FHA just going up, because that was the only game in town. But I remember very distinctly in 2019 going down to an originator in Georgia. I was helping them with some technology, and I drive up. This is in Atlanta, like North Atlanta, and it's like, one level corporate office, but in front of the building there's a Lambo, there's a Porsche, there's a bunch of other cars that I don't know the names of, and I'm just like, "Wait, what? Like, what's happening? Wait, this looks too familiar, right?" And, I go in and I'm talking to them, and they're like, "Oh," and I had met the night before as I was getting food. The hotel manager was telling me that he wanted to buy his first home, and I was like, "Oh, I might have a contact for you. It's a first time home buyer." And they're like, "Oh, no, 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 no. We don't want to deal with that. We don't want to deal with that." You know? But that was 2019, and
Yeah.
so u ultimately, it had already gotten started, and then it went, and that Dodd-Frank ability to repay, had teeth initially. It had a stated debt to income, but they removed that in 2021, as well as the GSEs, Fannie Freddie, always had a patch. They
Yeah.
never actually had to comply. And so for everybody out there that does the credit quality gospel singing and how much better it is now, they have no understanding of how this all actually works. Would you agree?
Absolutely. And I like that phrase, that the gospel singing. Uh,
Yes.
the credit, there's a significant amount of measurable good credit quality, but the amount of measurable bad credit quality is enough to sink a lot of people. I
Right.
look at, that FHA Neighborhood Watch website allows you to pull a really granular data, and you can pull by branch, by major lenders, by people closing 100 deals a month, and have 1 out of 3 of those go south the first year. We understand it because we're in the industry, but
Right.
there's no way that should even be considered allowed. And underwriters approving it. I mean, I see a sea of litigation later,
Oh, yeah.
and
Yeah.
it seems like FHA is some of the, like, one of the most recent. There was a taxonomy thing that they came out with, where they're preparing to do this to everybody. It wasn't my
Oh,
fault.
yeah. Oh, yeah. I mean, but that's the game. I
Yeah,
mean, I was in the middle of that game. So that's the game I landed in, in like, 2011, 12. I mean, everybody was, so the GSEs were charging compensatory fees. That was any timeline delay that you would have in servicing. But of course, none of the timeline delays were actually your fault. They were doing repurchases. So what will happen when these loans go delinquent, especially on the Fannie Freddie side, they're going to turn around and they'll make the servicer or originator repurchase those loans, because and they'll be like, "Oh, well, you didn't dot that I
yeah.
on page 180," and everybody now for some reason thinks this won't happen. I'm like, it's absolutely going to happen. It happened back then. This is the only way they remain solvent. Like,
Yeah.
everybody's going to point to somebody else. There's going to be somebody at the back holding the bag, and that's going to be the non-banks, because the banks will turn around and they'll pull a covenant out on them and be like, "Sorry, we're reducing your liquidity facility by 50%, get over it, and then all of a sudden you don't have any cash because you're a non-bank and you don't have deposits. I mean, this was the story of our lives. And so people, but it's just fascinating to me because so few people, and I think this is what happened last time because I remember, you know, probably around 2011 or so, you know, you go out, all of us would go out. We were working GMAC, the origination side, servicing side would be at the local bar and they get into fist fights. I mean,
Yeah.
because they just don't, very two different sets of people. But what ultimately happens in these big cycles is everyone on the origination side just disappears. Like they leave. And so there's no one else to turn to look. And so often, you know, the servicers and everybody else are the ones that have to clean up the mess. But this is going to be, and I call it the, you know, the regulatory cycle. And that's the one where all of the attorneys get super rich because I mean, the litigate, I mean, Mark, I've helped on cases recently that were 2005 originations that
Wow.
have not been resolved.
Yeah.
And there's a lot of those. And so this litigation, I remember the one of the big attorney firms that helped us, one of the main partners bought a boat and they named it after our company.
Interesting.
Yeah. So I totally agree with you. The attorneys are about to make a lot of money.
Bankruptcy attorneys also.
Oh yeah,
Yeah.
absolutely.
There was a HUD mortgagee letter on the discharge of partial claims in bankruptcy. You know, so there's some people that are looking at what's going to happen, and then there's other people
Really?
clueless. Yeah.
I have not seen that, and I
Uh,
would find, are they trying to make them not dischargeable?
they were trying to. I only glanced at it.
Okay.
I'll send it over to
I'll
you.
check it out. Yeah,
I
yeah.
believe they were trying to enforce that it would be dischargeable
Oh, okay.
in
Yeah.
bankruptcy, but
Okay.
that would only come out if they were knowledgeable about the fact that this mess is going to blow up. You
Yeah.
know, and one of the things that you had mentioned before I started looking at, you know, not there isn't a property shortage. There's a shortage of property that people want to buy in certain areas. I started
Mhm.
looking at metro areas and the amount of vacant properties,
Exactly.
and I think we might be in for kind of a sea change of people moving. Yeah,
Yeah. And I think that, we're about to see household sizes grow as, you know, multiple generations move in together because they cannot afford to live. And I think we've already seen it. It's just the census, it's, like, so lagging in terms of, you know, how we get this data and information. And so, you know, I think what's happening, a lot of this is already happening and people
yeah,
just don't realize it yet. Like, I mean, I take my situation, you know, probably 4 years ago, I was budgeting to buy a home for my mom. You know, she's 71, but by the time it got time for that decision, I was like, "No, I'm moving her in with me," you know, because it just didn't even make financial sense, to have 2 mortgages, 2 sets of insurance, property tax, and so, you know, I moved her in with me, got rid of my apartment, you know, we and consolidated, and I think that's happening all across the country right now, especially with the boomer kids, who can't afford the kids of the boomers.
yeah,
And you know, we've got boomers retiring at 10,000 a day. And this is significant, talking about that um vacancy issue because many of them own second homes. And Harvard recently just came out with its study that 15.6 million boomers will leave us between 2025 and 2035. And then between 2035 and 2045, that's 23 million. And so, you know, if you just do a rough kind of estimate, that's 30 million households and houses. So, like we've overbuilt. Another study that just came out, Taylor and Francis talked about that we built 3.3 million more units than we have actual households, you know, between 2000 and 2020. But the industry has been banging the drum that we don't have inventory, and I honestly think we're gonna soon realize that's because people stopped listing their inventory with the listing sites, and they
yeah.
started selling things on Facebook, and brokerage, certain brokerage firms took their stuff and kind of, put some arms around it and didn't participate. And so I think that that was really more about NAR losing relevance, or National Association of Realtors. And so I think that's what people will come to understand soon. But I agree with you. There's no shortage. And so these poor people who have believed everything they've read in the news, and I'm seeing it right now in client books. They're talking to the servicer. We're trying to sell. We're trying to sell. We've listed it since August. It's not, because if you're in some of these oversaturated markets, there's not a lot of hope. I mean, it's going to be really difficult.
Yeah, I believe firmly though that the hemorrhaging at FHA has to happen.
Oh
You know,
yeah.
yeah, I was looking again at some of the numbers, and one of the things was the servicer compensation for the partial claims and for those.
Right.
And I was just, without mentioning the servicers, the three biggest servicers of FHA loans, each made over $50 million in fees from servicing that delinquency. And the discussion would be that it costs them a lot of money to do that, but that's not including the fees that they make off of the quote partial claim that goes in there.
Well, let's call it by the right word. It's an incentive to the servicer, right?
Yes. And the servicer gets to, and when you break
It's like
it
a
down,
bonus. Yeah, go ahead. Yeah.
the servicer gets to buy or acquire a loan that shouldn't have been made in the first place in all probability. When the borrower goes south, they get to bring it current. They get paid for that. They continue to get their servicing premiums, and they get to do it repetitively. That's a good gig.
Until it runs out, right?
Yes,
until it really, and until they're advancing out. So it's a big Ponzi scheme. And if they're not originating enough, if they're not getting enough of that gain on sale, and we haven't gotten to this tipping point yet with those that both originate and service, but we're getting close. But as they start to advance out, because they have to advance out the principal and interest, the taxes and insurance, you know, on these loans when you're not paying. With Fannie and Freddie, it's only 4 months, but still, like, you have to do that. And then liquidity becomes an issue. And then they, oftentimes with FHA, this is what, supposedly fully backed by, the government. But in reality, when you try to file a claim, good luck. I've never once seen a claim. I manage the claims department. I've never seen a full claim payout ever. And then they take forever to review them. And then as they get overwhelmed, because they will, with those claims, then they'll be. I had claims at one servicer that were aging 3 years. Now think about this: if you need that liquidity, I mean, you can't keep that machine running at a regular pace to keep that gain coming from the origination if you don't have the initial liquidity. So it becomes it's the noose around the servicers' necks are getting tighter and tighter. And with these disasters, I can tell you, and I'm seeing it too as I do. One of the things that my company does is subservicer oversight. I'm seeing just servicers already getting overwhelmed with volume and loss mitigation. And so it's going to be so ugly, and it's going to be really just a repeat in many ways of what we saw previously, which is so crazy. This probably you and me who were in the industry when everybody was saying we're never going to do this again.
Yeah,
Right.
but there's lots of people that are motivated solely by personal avarice and greed that don't even consider what's happening.
Right.
I used to tell loan officers that I think everybody should be trained initially doing what I did, going door to door, doing collections, working on ugly side of the industry, to have a little respect for the transaction itself and for what you're doing.
That's so logical, Mark. I mean, that's just so logical, right? Like, that just makes it reminds me. So I used to wait tables. That's, in college, that's how I paid my rent or whatever. And it was the same thing. Like I started at a fine dining restaurant. We started in the kitchen and we made this first. We started with salads and we got on the fry cook. Then we were on the grill.
Mm.
Then we went out and we were a runner and, or what was the name of the people that would put the dishes together? I forget. But you would do you would do the hostessing, you would do every single job so you could get an understanding. And you might find this interesting. That was the approach I took at my company. I reorganized our departments completely and I made everybody train in all of the different areas and learn the process from
Yes.
beginning to end. And so, because if you don't know, you don't know. And so, making one widget, there's just not the same kind of investment when you're making one widget of a automobile. If you don't understand what that widget, the importance of that one widget to that automobile, and that automobile could get on the road and go 10 miles and completely fall apart and kill a family of 5. Like
Right.
that's what and I don't know, I think I shared this with you, but, my family lost our house to foreclosure when I was 9 years old. Our family fell apart, it was awful. These things, maybe they are well-meaning, but giving people credit that cannot afford it does not do anyone any good.
You're absolutely correct. And I agree completely with how you train people and how you do. Let everybody see the ramifications of what the action can cause in the
Right,
overall transaction. You
right,
know, when I it used to infuriate me when anybody working with me said, "Well, I'm just a." No, you're not.
right.
You're part of this, and
That's right.
everybody has a function. We have a responsibility from start to finish.
Absolutely. 100%. We've divorced actions from consequences, and I think the way the mortgage industry is set up right now I think it's meant to be that way. I think if you ever did life alone profitability, nobody would do this business anymore because it's now the government game and the margins are thin. You cannot make I mean, it's the government, the borrowers, the investors, none of them share the same vested interest. And so it is just a very hard game to play. But Mark, tell me. So we're getting close to hour. I just want to kind of turn it over to you. And what would be of all this stuff that we're throwing around jargon, and we apologize to the audience because we're insiders, but we're trying to give you some information so that you can maybe take a different uh, kind of view of what's being talked about in mainstream media in terms of delinquencies are at the absolute lowest. Everything's fine. Credit quality is better than it was. We don't have any issues. Mark, what would you want to say to people who, believe what they're reading?
To, I guess, take a realistic look at the basic arithmetic of what's going on. If you have uh, property prices that have increased threefold in 5 years, property taxes that have doubled, insurance that has doubled. Have incomes done the same thing? No. So, how can these property sales perpetuate at this rate? Be very, very cautious. You know, maybe somebody will pay $20,000 to go see a football game, but you can't fill the stadium with the people that will pay that. So if there's a paucity of people that are selling, you're going to have those properties bid up. But as soon as that intersection happens where supply and demand cross over, it's not going to be pretty. I would also, and this is self-serving to some degree, but I would also encourage people to look at properties that have existing government financing at a low rate to see about assuming the existing homeowner's mortgage.
Right.
And again, self-servicing, but if HUD is going to continue to do these partial claims that aren't, that have to be paid off, they ought to start looking at creating some type of an income producing loan to take those out.
Right.
I think I looked at this and it was of the 549,797 incentive claims paid in the last 12 months. If you think the average partial claim is 30 grand, which is probably light, that's $16.5 billion that's out there producing zero interest.
It's
Uh,
insane.
and that debt could be retired in a fashion that allows people to be selling properties and people to be getting affordable, because I mean, that $16.5 billion, that's got to be put back into the economy, right? I mean, if people
Right.
start having to make payments, that money gets taken from something else. I think people should be very cautious and not listen to uh, the sales media on property prices. And I listened to one of the things that you had put out, and it was, uh, I forget who you were talking to, but you were saying if the market increases, the median sales price would immediately go down,
Right.
right? If all of a sudden,
Yeah.
this is a bubble ready to burst.
Yeah. Yeah. Well, and Mark, so I love the football stadium analogy. Thank you. I will be stealing that, but giving you credit. I'll be giving it credit to the financial fossil, which, by the way, I love that saying as well. You've got some nice little sayings that I like.
Well, you mentioned, was your mother at 71? That's me. I'm 71 too. So thanks for making me feel old. No,
Well, no. You were a go-getter. You're out there. Everybody, ages differently, but you're still out there every day. You're looking at this data. You're digging into these numbers, and I'm so appreciative that you reached out to me, because I, I I've kind of taken one foot out of the origination side, and I focus more on, so it's good to talk about to people in the trenches and what they're seeing right now. And, you know, um, just the fact that so a lot of times what will happen when I'm looking at servicing, they'll refi out, right? And so I won't see that next partial claim or that next. So that it is a perspective that I hadn't been looking at. Now I'm going to be looking at more. So I'm super appreciative that you brought that to my attention. One thing we should probably mention is there's a proposal out there for them to limit the ability to do this. It has to 18 months between each time, but that won't even go into effect for a year if they do that. So the horse is already out of the barn. The destruction has already happened. And I guarantee you the fraud is absolutely massive out there, just massive, based on just a little bit of what I'm seeing. So I think a lot of people are going to be surprised. So I just want to say thank you so much for doing this with me today. But I just want to give it to you for any last words, any other things you'd like to say to anyone
Well,
today.
I want to thank you for saving my financial sanity, because I've been looking at these numbers, and my partner Jerry and I would be looking and saying, "This is a mess. This has to happen." People in the industry weren't concerned. Various people, again, the compartmentalized, and then I came across you, and I'm saying, "This is it." She knows exactly what's going on, so I appreciate the fact that you saved my sanity.
Well, excellent. And you saved mine as well. So thank you.
Thank you.
All right. All right. So thank you so much, guys, for tuning in today. Like, I'm hoping to do a few more of these where we really talk to some of the experts that are working in the trenches, so that you can understand the mainstream narrative really has little to do with what's happening. And there's just been a lot of moving the whatever is under that game, where you're like putting it, where's the
Sheldon.
penny, where's the shell, where is it? And I think that we've seen a lot of that in 2024, because it was an election year and nobody really wanted to deal with the mess. But as everyone can see over the past several days, things are getting very, very interesting. FHA themselves had to come out and say that they would not be impacted if, Trump's order moved forward. So a lot is changing, a lot's happening, and it's going to be really important to kind of understand the mechanics so that you don't get caught like some of these folks who I'm watching right now every single day. They cannot pay their mortgage. It's destroying their families. I'm looking at people that are talking about divorce because of this. And, that's the destruction of a family. That's the destruction of purchasing power as well in the future. So please be cautious. But thank you so much for watching, and I'll see you again soon. Thanks, everybody.
Thank you, Melody.